Hello, everyone. Shane Larson here from Composition Wealth. I'm joined today by our Chief Investment Officer, Matt Dymtryszyn. And today I wanted to take a few minutes to discuss private investments with you. Some of you may have already have seen we have some offerings in private investments. Some of you may be even in a few of them right now. But I wanted to take a few minutes to talk a little bit more about this new asset class. And kind of give a high-level view before we meet here at our next upcoming meetings. And then, when we meet one-on-one, we can discuss, if any of these may make sense to you and your portfolio. So with that being said, Matt, thanks again for being here today.
Thanks, Shane. Happy to be here.
So I guess right off the bat, Matt, can you just give like a high-level view and explain what are private investments and how they differ from the traditional stocks and bonds?
Sure. So private investments are just that. They're private companies that aren't traded on an exchange like the New York Stock Exchange or the NASDAQ. So you own the business and you're kind of stuck with that business until somebody else wants to buy it from you. So in fact, if you actually look at it, the number of publicly traded companies has been going down over time, and more businesses are staying private and electing to stay private. And that can be still owned by the founder, it could be a mom and pop business, or it could be a private equity firm that's an investor looking to actually buy private businesses and improve the operations and grow the value of those businesses. And so as I look at them, they're just extensions of the investment universe. A private equity business is no different than a public equity business. It's still tied to the same economic risks. It's still tied to the same supply-demand dynamics that go on within that given sector.
Okay, interesting. So with private investments, a lot like equities and bonds, there's different sectors and different sectors within that asset class. What ones right now do we think are the most attractive in the private investment space?
Sure. So we kind of look at private investments in three categories. So private credit, private equity, and then real assets. So private credit is really lending to businesses that are private. And so they're not publishing quarterly financial statements. And so you're lending directly to that business. As a private credit investor, you do get access to those financials, but it's still a private business. Private equity, we kind of talked about, is you own the business, you're an equity holder in that business. And there's different flavors of private equity that we can talk about. And then the last piece is real assets. And what we really put in there is real estate and then infrastructure. So infrastructure could be a cellular cell tower, it could be a data center, it could be a solar wind farm, a variety of true infrastructure assets.
Gotcha. Okay. So coming back there to private equity, how do you see valuations in the private space, and compare them to, say, the public equity space, what we see like on the S&P 500 now?
Sure, yeah. So, two things on that. I guess to start with, when we look at a private investment, we want to make sure our investors are compensated for not having that daily liquidity, being able to buy or sell on a given day. So we want an illiquidity premium. You should be paid more to do that. The way that kind of expresses itself in the private equity market is you should pay a lower price for that business because I can't just sell it tomorrow, versus a public stock. I should be willing to pay a little more for that business because if I don't like the way things are going, I can sell it immediately. And so usually there's a little bit of a cheaper price multiple paid. So the way we kind of look at it is kind of a cash earnings yield. So it's kind of the value of the business. What's the cash that I'm going to get out of that? And it's a multiple that in the finance jargon is your enterprise value, which is your equity and debt value, divided by your EBITDA, which is just another way of saying cash earnings. And in the public markets coming into this year, the S&P 500 as a gauge of public stocks was trading at 17 times EV to EBITDA, versus private equity was at 12 times. So there's you're getting it 5 multiple points cheaper, or close to about 30% discount. Typically, it's about a 2 or 3 point discount. So what we've actually seen is that widen. And what's really happened is in 2022, valuations reset across the board for public and private. Public equities have rebounded significantly, as we all have experienced some nice strong gains in equities in 2023 and 2024. That hasn't happened in the private equity market. Those valuations have stayed static, and therefore we actually see more compelling valuations in private equity today than we might have said 3-4 years ago.
And now with private credit, I'm sure a lot of our investors here have heard of private equity. Private credit, can you talk a little bit more of how should investors think about this within their portfolio, and what are some of the opportunities in that sector in particular?
Yeah, private credit, in some regards, not always, goes hand in hand with private equity. A lot of times, private credit are loans to businesses owned by private equity companies. And the way I really look at private credit is it's comparable to high yield bonds. So there is risk there. These are companies that have above average levels of debt. I think that the difference between high yield and private credit, though, is by those companies being owned by a private equity sponsor, if something goes wrong in the business, that private credit can take the keys to the business and sell it or fix the business themselves. If you're a private equity investor and you've bought the business, gotten a loan from a private credit company, you're less likely to want to hand those keys over. And quite frankly, you have a fund that you can draw capital on to help support the business in a bad time. And so in that sense, it's nice because even though there's capital behind that investment, that kind of makes it kind of a little bit stronger capital structure behind the scenes. But to be transparent, these are businesses that have a little bit more leverage to them. They're equivalent to a double B or single B rated high yield bond.
Gotcha. Okay. And then the last one, you mentioned real assets. I think, think about real estate specifically, commercial real estate has been experiencing a lot of headwinds recently with rates rising, things like that. How could some of these real asset strategies create opportunities for investors?
Yeah, so like one of the things we really like now is commercial real estate debt as an area. So when we look at the real estate equity area, you kind of mentioned real estate prices have corrected, but I wouldn't say they're extraordinarily cheap by any sense. So they're down about 20% over the last couple of years. But if I bought a real estate property today, call it just a Class A multifamily property, I'd get about a cash yield of, call it somewhere in the 5 to 5.5% range. But if I wanted to put debt on it, I'd have to pay 6 to 7% interest rate. So you're still kind of having to dip into your pocket to pay the interest expense. Not as attractive. We think maybe a year or two from now that could change. But in the short term, if I lent on that business, I'm making yields that are kind of in the 8 to 10% range, and I've got an equity investor below me. If things go wrong and all of a sudden that particular property, we have more vacancies than we thought, that equity investor is going to be the first to lose money before I am. And so we think that's pretty attractive. And quite frankly, there's an interesting dynamic going on in the real estate financing market. There's this commercial real estate maturity wall. And so there's actually a bunch of maturities coming due in the next few years. And the reason that's happening is banks are stepping out of the lending space to commercial real estate. And they're doing it partially because of regulatory reasons, because of more capital constraints. But the other piece is they've been hurt on, as you mentioned, Shane, real estate prices coming down. And so that's kind of creating a void for new lenders to come in. And they're coming in and they're able to get higher interest rates as a result. So investors in those strategies are actually able to benefit from that.
Okay. So when thinking about private investments, these are going to be new to a lot of investors. What should investors know about these particular types of investments?
Sure. Yeah, I think there's probably three key things to keep in mind. So there's liquidity, there's qualifications, and there's fees. So these are private, and there's not always readily available liquidity. There's varying liquidity terms based on the individual fund and private investments. Some allow access to quarterly liquidity, but that usually has a cap on it. So they may sit there. The standard term is typically, well, we're not going to allow more than 5% of all the capital out of the fund. So if you're the only investor that wants out, you might be able to get out. If everybody wants to run for the door at the same time, you might not have access to liquidity. Other funds, we would call them drawdown funds, or you're making a commitment for a multi-year period of time. It could be 5 years, it could be 10 years, depending on the fund. So liquidity is something to think about. The second is qualifications. So each fund has their own range of qualifications. And so it could be you have to have a net worth of a certain level, or you have to have an income of a certain level. And so that can vary. And then the last piece just being fees. And I'm a cheap individual. I like things low cost as I can get them. So just full transparency, private investments do have higher fees. We take that into account as we evaluate these. And if we don't think you're getting an adequate illiquidity premium net of fees, we're not going to recommend it. But there are higher fees, and it depends on the strategy what those fees are. Often it's very rare you get something under 1%, but some of them can be north of 2%. It just depends on the underlying strategy. Again, we think about that as we do our research and look at that expected underlying return. But I will say the flip side is these are strategies that are doing more work. If a private equity firm, they're sitting on the board of directors, they're doing all the due diligence to acquire the business. If it's a private credit firm, they're writing the loan documents. It's different than a high yield bond where you just submit an order and buy it. So there's a lot more work that goes into it than it would be in a traditional just buying a stock or buying.
Gotcha. Yeah, and we're still conscious of the fees, but like these types of investments, you would say they're doing, as you just mentioned, a lot more work than your traditional, mutual fund or ETF or thing like that. This is really a lot more is going into that.
Exactly.
Perfect. Well, thank you, Matt. This has been super informative. And thanks everybody for watching. I look forward to our next meeting to discuss this and how they might fit into your guys' overall portfolio. As always, I'm here as well as the team if you have any questions or concerns. And again, thanks for stopping by. And Matt, again, I appreciate you sharing your knowledge on this asset class.
Thank you. Happy to.
All right. Thanks, Matt.